From the world of politics to the world of business, this is Balance of Power with David Weston.
From Bloomberg World Headquarters in New York to our television and radio audiences worldwide, welcome to Balance of Power. As we close out the week, a very big story is China. What is going on in China and whether we know, as the government released some of the relieves them for some of the restrictions on people going outdoors, it's not clear they're going out of doors because of all the infection rates. So to get a read on that, we turned on Nick Wadhams. He is Bloomberg national security correspondent. Nick, thanks for being here. What do we know about what's really going on in China right now with respect to COVID?
Well, what we can say is that the government has essentially done a U-turn after imposing a COVID zero policy for essentially since the start of the pandemic. The government has basically lifted all restrictions, but it really looks now like COVID is spreading rampantly through the populations in places like Beijing, and folks are really staying off the streets. The anecdotal evidence we've seen, some of the video images there, are that people are basically not going out, trying to keep themselves from getting infected. There was a recent report saying there may be up to as many as 1 million deaths in China from COVID. So the government has loosened restrictions, and we are now seeing the virus spread pretty quickly.
Nick, as you said, it's anecdotal. At least the evidence I've seen so far is anecdotal. Do you have a sense, because you cover national security for Bloomberg, do you have a sense whether the government, the U.S. government, has better data, actually hard data? Do they have a better sense of what's going on than perhaps we do?
I think they do have a pretty good sense from of what's happening in China to some degree, but there's a real caution by this administration. They have not wanted to come out and criticize China's approach to COVID in a really direct way, both when there was COVID zero and now. But what we are seeing is a general increase in communication between the U.S. and China. You're going to have Secretary of State Anthony Blinken go there at the beginning of the year. The Treasury Secretary, Janet Yellen, may go. So the U.S. is trying to see this as an opportunity to engage with China. And frankly, I think what they want is basically to stay out of it and to not get involved in making any public comments about what they are or are not seeing in China right now.
Nick, thank you so much for joining us today. That's Nick Wadhams. He's Bloomberg national security correspondent. We turn now to an expert on China, and specifically the Chinese economy. Mary Lovely is senior fellow at the Peterson Institute for International Economics, professor emerita of economics at Syracuse University. So, Mary, great to have you back with us. What are you hearing from your sources about what is going on right now in China with respect to COVID-19?
Well, China is experiencing very rapid transmission of the virus. I think a lot of people on the ground are trying to figure out what to do. Of course, for many people, the illness is not severe, does not require hospitalization. The big wild card is going to be people over the age of 60, many of whom do not have a third vaccine or a third shot. And it's just a gigantic wild card as to, what kind of protection they actually have against this surging virus.
As I said, Mary, you really know economics in China particularly well. What are the possible ramifications for China and the China economy if, in fact, even after let back out of their apartments and their houses, they can't come out because they've gotten infected?
Yeah, I mean, it's a tough story. I think, one of the motivating aspects for the Chinese government was to get the economy growing again. The economy had slowed down tremendously, and that's a very difficult balance between public health and economic health. The November numbers are quite startling. They show that the Chinese economy has continued to slow. Retail sales in November shrank by 6% compared to a year earlier. Industrial production growth dropped to a 6-month low. Production fell in very important industries, including autos, electronic devices, chips. So the government has some really stark economic conditions to deal with. And whether we will see an uptick in this in December, January, really depends on people's response. And right now, it looks like the next 3 months are going to be really tough slogging economically as well as on the public health front.
What does this potentially mean for President Xi as he's just starting his third term there? This is certainly not the way he wanted to get it started. How vulnerable is he? Because he was so adamant about the zero COVID policy, and now he's come off of it. It's not clear to me from the outside, at least, what the theory was, how you come off of it. What does it mean for him potentially?
I mean, he has lots of his folks in place. I think the criticism that really bites is that not that they were wrong to pursue zero COVID, it worked for them for a long time, but that they were slow to react or adapt their policies to changes in the virus conditions, slow to prepare. And this, of course, is going to have an impact. So, for example, we know that some of the funds they've given to local governments or allowed local governments to raise through capital markets were used for quarantine facilities, which are now virtually worthless. So it has led to investment that will have very low return. Those facilities may be turned into something else, but right now, they're not useful. And so it's not just on the COVID slow to adapt, it's also on economic stimulus and how to deal with the economic fallout, first of the lockdowns and now the surging virus.
Mary, if that's a snapshot of the Chinese economy, what does that mean potentially for the global economy, for the U.S., but also the global economy, if in fact China is going to be slowing down or continuing to slow down and will not be coming back as fast as we had hoped?
Well, certainly it has implications for commodity exporters. If the Chinese economy remains sort of moribund, there are lots of folks who are worried about supply chain disruptions again, and that's certainly possible. Although I think we're not going to see a repeat of what we saw earlier in the COVID era, particularly because local governments will take steps to try to avoid large-scale lockdowns. However, we can't rule them out altogether. As you mentioned at the top of the hour, there is potential for up to 1 million deaths. We hope very much that those are wildly overestimates, but there is the possibility out there. And if deaths do surge, local governments will have to take steps. People will be afraid to come out of their houses. So supply chain disruptions certainly are not out of the question over the next 3 months.
Mary, moving to another issue that's of great importance to China and to China's U.S. relations, semiconductors, because there's a lot of talk about whether there's an economic Cold War going on or we're going to have it or not. But boy, as I look at it in semiconductors, there really is sort of a Cold War, isn't there?
Well, the U.S. has certainly gotten more aggressive in its stance. As we know, Jake Sullivan, the U.S. National Security Advisor, has said not that we want to just stay a generation ahead, but we want to basically make sure they can't progress from where they are. And that has led to not only sanctions on chips, but also on equipment that produces chips. How much of an impact this will have on China is not really known. It clearly will impede their ability to move to the frontier. But a lot of what they use for civilian and military uses is, in fact, not frontier chips. So there are many people who question how big an impact this will have on Chinese military modernization as well as its economy. It is clearly seen as an escalation. However, with President Xi and President Biden meeting in Bali, with Secretary Blinken heading to Beijing, we may see the U.S. and China agreeing on this is where we're going to be for a while. There's no benefit really for the Chinese in escalating here. So we may not see an escalation from this.
Well, I'm very curious about that specific point. I was going to ask about the meeting between President Xi and President Biden. Leading up to that, there was a lot of talk about setting out red lines for both sides, what you can't go over. Are semiconductors even on the table for negotiation at this point, given the positions of the two countries?
Just from the U.S. side, I would say no. The U.S. has made its decision. It is following through. It is pushing its allies to join. Those efforts are ongoing, so I don't think this is a negotiable point on the U.S. side. There's still a lot of other areas where they can cooperate, and some of those are economic. We could potentially still see some revisions to the Trump-era trade war tariffs. There's other ways in which we can cooperate. One good sign is that we're beginning to see delegations of scholars and business people coming back to the United States. Not immediately, but over the next 6 months, we may see U.S. uh, scholars and business people going back to China. So there is a possibility here that we will reach some kind of a new normal. Not immediately, but say over the next 6 to 12 months.
Okay, Mary, that was very helpful, as it always is. Thank you. That's Mary Lovely, Senior Fellow at the Peterson Institute for International Economics. Coming up, Congress has now given the Pentagon $858 billion to spend. We're going to ask former Acting Secretary of Defense David Norquist what it will do with it. This is Balance of Power on Bloomberg Television and on Bloomberg Radio. Balance of Power on Bloomberg Television and Radio. I'm David Weston. Overnight, that National Defense Authorization Act made it through the Senate. It had already passed the House, so it's on its way, apparently, to the president's desk for signature. To take us through exactly what is included in this $858 billion, count them, in this authorization, we turn now to David Norquist. He's president and CEO of the National Defense Industrial Association. Mr. Norquist served in various senior positions in the Department of Defense, including as acting Secretary of Defense under President Trump. So welcome. It's great to have you with us. So give us some sense. As I understand, it's more than was requested by the White House, and it's something like a 10% increase year over year.
That is correct, David. So what happened is when the administration submitted the budget before Congress, it built it on the assumption that inflation in 21 and 22 was going to run around 2.1%. And that didn't happen. And so it was off cumulatively about 9% just for the effect of inflation. And so that has a driver to the Congress when they're looking to fund national security. They needed an increase of about 42 to 45 billion just to cover that. And that's about the number that they ended up on, was trying to adjust for that. Now, within that, what you notice is, first of all, a very bipartisan vote coming out of the Senate, 83 to 11. It really reflects across administrations and across parties an understanding that Russia is the near-term challenge. So you see investments in munitions and support to Ukraine, and China is the long-term pacing challenge. And so you'll see investments in the nuclear triad. They just rolled out the new bomber a few Fridays ago. And those are designed, one, to enhance deterrence now that you're facing multiple nuclear powers, as well as to invest in the long-range strike that you would need to be able to deter Chinese aggression in the Pacific.
So if I understand correctly, there's also a pay raise for our soldiers and sailors and airmen of some 4.6%, which is a lot less than 10%. It's less than inflation right now, but maybe not by the end of the year. So what does that mean that it's 10%? That means for the rest of the budget, it's a lot more than 10% in order to make that up, if I'm doing my math right.
Right. So what you have with pay is the civilian and military pay in the Department of Defense is linked to pay raises in the private sector. So I think you were in one of your programs earlier this week, you talked about how the change in the inflation rate and the change in salaries have moved up at different times. They will track the change in civilians and commercial salaries and reflect that in the pay raise this year. And you should see it in the February budget when they roll out the change that reflects the private sector. The other ones reflect both the investments. The other increases go to the investments Congress wants to see in additional shipbuilding capacity, additional long-range strike, as well as just getting the inflation numbers correct that I'd mentioned earlier.
I have no doubt at all that all of that is useful. The question is it strictly speaking necessary? Because I can feel a lot of Americans saying, you know what, inflation is taking a bite out of me as well. I have to sort of tighten my belt a little bit. Why is defense exempt?
So defense is not exempt in the sense of all the pressures on the budget. And if you think about it, the defense budget cycle is very long. And so the 21 and 20 budgets that were enacted without adjusting for inflation, they're trying to buy things now after inflation. So the department's going to lose about $50 billion in buying power from its previous budgets being built off the wrong assumption of what future inflation would be. So they're facing some of these trade-offs and challenges. But what they're looking at and recognized on a bipartisan basis is a very different strategic environment. You have a Russia that isn't just potentially aggressive, is actively invading its neighboring country. And you have a China that shifted from the strategy of buy your time to being much more aggressive in the South China Sea, much more threatening to Taiwan, and the realization that they are increasing their defense spending by a much larger percentage year after year, and they have lower labor costs. So you've got the challenge of keeping up and deterring. And there's a number of areas where either through innovation on their side or stealing technology, they're very competitive. So the U.S. hasn't had a pacing challenge of a country whose GDP is about the same size as ours. And that's what both Republicans and Democrats are looking at and saying, we need to stay in front and be able to do this because national security is the foundation for our economic growth.
Growing faster, but off a much lower base. Is that not true? I mean, I think I've read that we spend as much as the next 11 countries put together.
So they start from a lower base, but there's two things to recognize. Part of the reason why some industries have moved their business over there is labor is cheaper. So the amount of money they spend to build an aircraft carrier or destroyer because of the labor costs is lower than here. In addition to which, they have a single area of focus in the region of the world where our footprint, we're both worrying about potential issues in Europe as well as in the Middle East and in addition in the Pacific. So there are more challenges that we have to be able to cover. So what you're looking at is trends going in the wrong direction and wanting to stay in front of those trends.
One last one. I don't want to let you get away without asking the broader question because you've been involved in this budgeting process with the U.S. government. We're in the middle of it once again. There's another continuing resolution going to the 23rd of December now. It's unclear whether they get an omnibus after that or not. Give us your take on what's really at stake and the choice between, for example, continuing resolution on the one hand and an omnibus on the other.
Right. So CRs, for those who don't live inside Washington, is when Congress gets to the point where it's supposed to enact the budget, it says, I'm not ready yet. And it gives itself an extension, either a couple of weeks or most recently, a couple of months, and then this time a week to get to next week. Those are poisonous and wasteful. If you think about it, with government spending, you're telling the people in the Pentagon who do the operation budgets, spend several $billion less than you would normally for 3 months or 6 months. And then at the other side, we'll try and make it up by spending it faster. That's not a good use of taxpayers' money. But the bigger challenge is a CR prevents new starts, new innovations. And so with a country that depends on new technology to deter the Chinese and stay ahead, telling people to put the brakes on innovation is really a gift to the Chinese. And so what we want to be gentle of is if it takes a week to get this finalized, that's great. But if you end up not being able to resolve it before the end of next week, then it's going to push into next year. You can have new committee assignments, and they'll probably slide until March. That's very destructive. It's not a great use of taxpayers' money, and really puts us behind on innovation. So very important that they come to agreement on this, and I'm looking forward to and very hopeful that they will.
That's a very helpful perspective. Thank you for sharing it with us. That's David Norquist. He's former acting Secretary of Defense. Coming up, we're going to go to Jared Bernstein at the White House for the administration's views on what we saw this week from the Fed. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Wall Street Week, we talked earlier today with former Treasury Secretary Larry Summers about his reaction to the eco numbers out this week and Fed Chair Jay Powell's response.
The chairman is in about the right place. He's recognizing that we can't forecast the economy with precision. He's recognizing that it would be a terrible error if we were to fail to stop inflation in this episode.
For a reaction from the White House now, we turn to Dr. Jared Bernstein. He is a member, of course, of the White House Council of Economic Advisors. So, Jared, you've always been very careful, and appropriately so, to say you're going to say whether you agree with Jay Powell, disagree with you, doing a good job or a bad job. Let me ask you a different question. They came out with a statement of economic projections that some people on Wall Street are really taking issue with, saying that they think inflation is higher, according to the Fed, than it's really going to be, and that as a result, the rates are going to have to go higher. What are you telling the president is the right number?
Well, the president really wants a sense of where we think things are headed. And probably most importantly, since he's very focused on how inflation is playing out in household budgets, what can we tell him about how these things are evolving in real time? And there's answers to both of those questions. Starting with the latter, in real time, we know that we've seen slower inflation in some key areas in not just one, but in a couple of recent prints. So we have some slowing, some deceleration in top line, and even in the CPI in core inflation. We know that core goods inflation seems to be responding pretty well to improvements in the supply chain. We know that while housing inflation is still quite strong, we expect that in the back half of next year, it's going to start reflecting some of the price declines we're seeing now in that sector. And we know, and this is something that Chair Powell Powell talks about that non-housing services inflation is tied to the labor market and still creating pressure. So we reflect that to the president. Over the longer term, the question is, and without getting into precision, Larry's right, there's big confidence intervals around these forecasts. Without getting into any level of precision, we explain that the trend has been our friend here, and if getting under the hood and that kind of decomposition I just shared with you, we expect those trends to largely continue. And so that's probably what we're communicating to him.
So I'm going to get way out over my skis here and actually look at some numbers, even though I'm a liberal arts guy. And I understand the numbers out, particularly the CPI numbers, look like the inflation is slowing down. But the SEP, and as I understand it, Jay Powell said they took the CPI numbers into account, actually showed it going up. They had been in September projecting 4.5. They're projecting 4.8 now for 2022. And that resulted in taking up their numbers for 2023 as well. This is core PCE inflation to 3.5. So are they mistaken that, in fact, it's accelerating here at the end of the year?
Well, I mean, I think there's some questions as to whether the updates reflected, whether there were updates that reflected the most recent print. I know there's been some back and forth on that today. Let me just be very clear about this. What we're focused on, and in terms of the SEP, where I think our projection with large confidence intervals a la Larry are similar to those that you'll see pretty much from market forecasters, is that at the end of next year, we expect inflation to be considerably lower than it is now. That's the forecast. But look, we've seen head fakes before. We recognize that we have to really keep a close eye on these trends. The war in Ukraine and its pressures on commodities are still out there. But again, the thing to do to understand this is to not just have free-flowing anxiety about it or even focus too carefully on any particular point estimate, but to think about the decomposition and the dynamics in play. Core goods inflation seems to us to be responding to improvements in supply chains. Housing inflation is, as we discussed, and then the non-housing services part of inflation, what the Fed talks about as an area of continuing pressure, that's pretty linked up to the pressures in the job market. Now, we have seen those pressures come down to some degree. We're seeing slower but still very solid job gains. We've seen some deceleration in nominal wage growth. So I think kind of steady as she goes. I mean, this is a lot like what the president wrote about back in March of this year in an op-ed where he talked about transitioning to slower, steady, stable growth. And I think that's largely what we're seeing.
Jared, it's always such a pleasure and really helpful to have you with us. That's Dr. Jared Bernstein of the White House Council of Economic Advisors. Coming up, we're going to talk with Michael Froman of MasterCard about what they see ahead for the global economy. That's coming up next on Balance of Power on Bloomberg Television and on Bloomberg Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. I want to keep you up to date with news from all around the world. And for that, we turn to Mark Crumpton here with the first word.
David, thank you. New York Fed President John Williams says the tight labor market makes it necessary to have higher interest rates. Williams spoke with Bloomberg's Kathleen Hayes.
We have clear signs that demand exceeds supply in our economy and our labor market. So to me, the question of how high we have to get to is really going to depend on what we see in inflation and the supply-demand imbalance. We're going to have to do what's necessary, again, sufficiently restrictive to bring inflation down to 2%, and it could be higher than what we've written down.
Williams also said he expects inflation to slow to 3 to 3.5% to that range next year. The Biden administration plans to purchase 3 million barrels of oil to replenish emergency reserves. Senior officials say the move will tame high gas prices. In addition, the Department of Energy is planning a roughly 2 million barrel crude oil exchange. The effort will support emergency supply needs caused by the shutdown of the Keystone Pipeline. Bloomberg's learned that Goldman Sachs will eliminate as many as 4,000 employees. Top managers have been asked to identify potential cuts. Headcount at Goldman has surged in recent years. Meantime, the consumer banking unit suffered its deepest losses yet, and there's been a slowdown in deal-making. American Nobel Prize winner Philip Dybvig faces a sexual harassment inquiry at Washington University in St. Louis. A former student is the accuser. Bloomberg has spoken to 7 former students who allege that Dybvig sexually harassed them. His lawyer says he never had any improper physical or verbal interactions. Dybvig won this year's Nobel Prize for Economics. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thank you so much, Mark. Well, we're all trying to get our arms around the economy, whether it's the U.S. economy or the global economy. And for that, we love high-frequency data. And when it comes to high-frequency data, there's maybe none more high-frequency than how we use our credit card. So to get a read on where we are with the economy, we turn now to Michael Froman. He is MasterCard Vice Chairman and President for Strategic Growth. Ambassador Froman served as United States Trade Representative under President Obama. So thank you so much for being back with us. Let's start with the U.S. as we go into the holiday season here in the United States. What are your data showing you about where we are, where the consumer is right now in the United States?
Well, our data is showing that the U.S. consumer is still pretty resilient, and consumer spending reflects that. It may be changing a bit. There may be fewer big household item purchases, more focus on services, on travel, on experiences. We see some interesting changes where people are going to the grocery store substantially more often and spending a little bit less each time they go. And so behavior is being affected, but we still see strong consumer spending resilience. And that leads us into our expectations for next year, where we expect the U.S. to see limited real economic growth and some divergence perhaps between the U.S. and other parts of the world.
I want to come back to the rest of the world in a moment, but just before we do that, a lot of people think that the reason why the consumers hung in so long is because of the savings they've had. Are you starting to see some of the credit balances move up in a material way?
We do see some increase in credit balances. They went way down during COVID. People paid off their debts, paid off their credit card balances. We do see some increase credit being extended now. And we see, as you can see from the travel, particularly cross-border travel and domestic travel, a big thirst for getting back out there and to spend and consume in those experience and service economies.
So let's turn to the rest of the world, because we hear tell as how there's differences, obviously, in the economies, particularly, for example, in Europe, it's thought that it's more likely to have a recession. What differences are you seeing geographically around the globe right now?
Well, we do see some slower growth in Europe and expect a decline in economic activity next year. I think with regard to the emerging markets, it depends a little bit of where they are in the supply chain. Commodity producers may see some continued growth. Others may be more adversely affected by what's going on with interest rates and inflation rates. So much still to be determined, but we do see this bifurcation or this divergence from one set of markets to another.
Let's go back to your old job as U.S. Trade Representative for a second, because people are concerned about a possible global recession, and trade is one perhaps remedy to that. What are you seeing in terms of trade right now? Because there's a general sense, I think, that we are, if not moving to deglobalization, at least less globalization.
I think globalization is still here, and it's here to stay. It may be changing in its focus as supply chains get slowly reorganized and more regionally, closer to home, more friendshoring, as some of the administration call it. But we still see a fair amount of cross-border trade going on, and really no slowdown in that kind of activity. I think, look, over time, there's a lot of geopolitical tension. The countries are focusing more nationally. There's a rise in nationalism in several markets around the world. But the supply chains are still very much cross-border, and we see, while some investments coming back to home markets, investment is continuing to be made in various markets around the world.
Our friends over in Europe would say that some of that nationalization is right here in the good old US of A with that Inflation Reduction Act and what it did with respect to homegrown green energy projects. What about that dispute? Because clearly it's something, for example, President Macron raised with President Biden. From your point of view, and particularly as a former USTR, is that resolvable?
Well, I had the pleasure of working both on climate and trade during my time in government, and now we see the two coming together. I think for years, even decades, the Europeans have been urging the U.S. to be more ambitious when it came to dealing with climate change. Their form of ambition tends to be reflected in regulation. That's what they really focus on. Ours is more on innovation and production of new technology. And I think the Inflation Reduction Act was a major step forward in investing in addressing climate change. And for those countries that have free trade agreements with us, there will be an opportunity for them to participate in those supply chains as well. Europe, as you recall, we were involved in a free trade negotiation with them for some time, never really had the political will to get that done. And I think now they're seeing some of the effects of that as well.
But and correct me if I'm wrong, I thought the Inflation Reduction Act was a specific instance of a broader Buy America orientation. And President Biden's been very explicit about that. Does that make sense? Because a lot of economists say that is inflationary, actually, and it actually deters global trade, which is not in the long term good for growth.
I think Buy America generally does raise prices and can have that effect. Here, though, you have an occasion of really focusing on an urgent need to bring energy efficient and electric vehicles, climate change addressing technologies to the market as quickly as possible. And there's a certain urgency to that. And so in my view, while it's not great for the global trading rules, if there's ever to be an exception, I think the exception to address climate change is one that may well make sense.
As you know, Mr. Ambassador, President Biden just had a summit in Washington, the Africa summit, saying we're really going to put a new emphasis on Africa. He's going to travel there. We're going to do some more trade. We're going to do some more investing. I know that you're involved around the world. Give us your take on Africa, and maybe more specifically, why thus far, it's my impression at least, has this private sector in the United States not been more active in Africa?
Well, I think there's a lot of opportunity there right now, particularly as the economy's become more digitized, and there's a lot of entrepreneurs, a lot of entrepreneurship in the continent, a lot of fintechs, for example, that we see growing up that we're partnering with. We've been very focused on financial inclusion in the region and really digitizing the base of the pyramid, bringing tens of millions of people into the digital economy, giving them access to capital, giving them access to markets. I think that is a great opportunity for the private sector to be involved in Africa. And I think it's great that the president convened this summit. The more others are in Africa, including China, the more folks on the ground there want the U.S. to be involved. And so wherever the private sector can find good investments to do on a risk-adjusted basis, whether it be in energy or whether it be in digitizing the economy, I think there's a great opportunity for them to do so.
Well, on the digitizing economy, particularly access for people to banking services and digital payment services, I guess it really does lead me back to cryptocurrency, because we've heard that maybe that's a use case for cryptocurrency for people who are looking for one. Give us your experience at MasterCard about whether you need cryptocurrency, whether that makes it better, facilitates it, makes it more efficient.
No, I don't think that case has been proven out yet, that cryptocurrency is the panacea to financial inclusion. We've been working on it for the better part of a decade. We've committed to bring 1 billion people into the digital economy, 50 million micro and small merchants, and we're well on our way towards doing that using the mechanisms and the technology that we have. There may well be a role for the technology underlying cryptocurrencies in many, many markets with many different use cases. But I think in terms of financial inclusion, there's a lot of good work to be done with the mobile telecom companies, with farmers, with small business, with the consumer product group organizations, and really getting to folks who are particularly small businesses, farmers, and individuals at the base of the pyramid who so far have been left out of the system and now have a real opportunity to participate.
Okay, Mr. Ambassador, thank you so much. It's always a pleasure to have you with us, and we always learn a lot. That's Mike Froman. He is former U.S. Trade Representative, now with MasterCard. Coming up, Roger Harris is the president of Amtrak, and he has a new train to show us. That's coming up next on Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For those of us who grew up with Lionel train sets, and the prospect of getting a brand new train has always been terribly exciting. We're going to turn to Amtrak President Roger Harris, who has a new train that I understand he's going to share with us eventually. So, Roger, thank you so much for being with us. Tell us about this new train. Is it pronounced Airo, A-I-R-O?
That's right, David. Thank you, and thanks for having me here today. So it's the Amtrak Airo. We announced the train order last year, but this is our opportunity to put a name and a face with the new train.
So tell us what's so new about it, so much better about it. And by the way, when do we get it?
Well, let me tell you when we're going to get it. We're going to start operating them in 2026, so it's not immediate by any means. But the great thing about these trains is that they're modern, spacious. They have huge panoramic windows, ergonomically designed seats, very customer-friendly food service, and all around a far better customer experience. Modern, bringing us into the 21st century.
So you are in a customer service business, so you must have done research. Is what came back that what we'd really like is new trains that are more spacious and have better windows? Is that what the customers want in order to flock back to Amtrak?
Absolutely. So what we tried to do is double up on the things that make train travel better than any other form of transportation, and that's the spaciousness, the independence of walking around during the journey, the ability to look out the window and see some of the best views that this country has to offer. So we're doubling down on what we already do really well.
So give us a sense of people, as I said, flocking back to Amtrak. As I understand it, you've made progress coming back from the worst of the pandemic, but you're now all the way back by a good long shot. Where are you?
Well, this fall, we're at about 85% of pre-COVID demand. And in certain parts of the country, like in the Northeast, we're really back to where we were in 2019. And we think that that really represents not only a really encouraging sign, but it also speaks to the renewed interest in rail across the country.
And does the business plan work if you're at 85% capacity or 90% of capacity? Where do you need to get to in order to really make it work?
Well, that is a real challenge. This is a high fixed cost business. And really, so any incremental capacity that we can put into the market really does result in better operating margins. So that is a really big focus of ours, is to put more capacity back. But we also have the challenge of spending some of the enormous funds that are available from the bipartisan infrastructure law. And so as we ramp up to invest in those capital projects, it will also increase our spending on running things like more employees to do the work, et cetera.
How sensitive are you to the economy overall? I mean, there's a lot of talk about the possibility of a recession next year in the United States. If that happens, what does that do to your traffic? How much is it affected?
Well, at this point in time, we really have, I think, more demand than we can cope with. So we have a certain amount of excess demands. The problem really would be if business travel drops off a lot. So up in the Northeast Corridor, we have seen a good return to business travel, which is really important to us. So that's what we're going to keep an eye on.
I'm sure you're sick and tired of people saying, boy, the trains in Europe are so much better than they are in the United States. But one question I have is, how much do governments in Europe subsidize those trains?
Well, by our count, it looks like about $1 trillion was spent in the last 20 years in Europe on infrastructure investment for rail. And that's one of the big differentiators. And the real challenge is, as much as the bipartisan infrastructure law made available to rail, it's really a drop in the bucket. And many of these projects take 10, 20, 30 years to come to fruition. And so even though we spend the money today or we start spending it, we don't see the benefits oftentimes until far into the future. Now, it's really important to note that these are very long-lived assets, so they may have 100 years of value, but getting from here to delivering the project takes a long time.
Finally, if you would, what does this mean for the climate? I understand your new Aero train will be more fuel efficient than others, but do you have targets for exactly what you're going to do with emissions?
Yeah, so net zero by 2045 is very important to us. We are converting as much as possible in the meantime, trying to shift to green energy on our electric traction, and also looking for new technologies such as hybrid battery trains, but we're not quite there yet.
Okay, thank you so much. It's really a treat having you with us, Roger. That's Roger Harris. He is the president of Amtrak. Coming up, we're going to get the latest on the market sell-off in the wake of the Jay Powell News Conference this week. That's coming up next with Kriti Gupta. This is Balance of Power on Bloomberg Television and on radio. This This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. As we close out the week, there's a lot to talk about in the markets, and here to do that for us is Kriti Gupta. So, Kriti, first of all, let's start with there's been something of a sell-off since Jay Powell had his little news conference. Is that continuing today?
It absolutely is continuing today, and it's a pretty powerful one. Stock market down about 1.6%, the NASDAQ down 1.4%. This is a continuation of that. Remember, you did have a buildup in the stock market going into the Fed meeting, and of course, the CPI report that showed faster than expected deceleration of inflation, or disinflation, if you will. That was helping the stock market a little bit, but the Fed kind of throwing a little bit of cold water on that, saying, you know what, it doesn't quite matter just yet. This is only the second data point, and just 2 data points does not make a trend. So they are still waiting for that, and they said they're going to stay quite hawkish when it comes to that. They've made it quite clear. Chairman Powell has made it quite clear, I should say, that he does not want to for it to become a Volcker repeat. And I think that was the takeaway of that particular message. But remember, today is also options expiration. You have about $4 trillion of options, worth of options expiring today. So there is a lot of kind of liquidity here. They're going to try to get in and out of those contracts, really keep an eye on what happens going into the market close, because of course the big move was this morning, and that's where you saw that really big slide, especially in futures contracts, to the tune of about $2.8 trillion. The afternoon settlement, though, is expecting about $1.2 trillion. So really keep an eye on those fund flows today.
So I have to ask, we're coming up to Christmas.
You're coming up to Christmas.
What's happening to Santa?
Oh, are you
Santa rally?
Are you asking me if you bought me a gift?
Yeah.
Not quite yet, and I think that's almost concerning because it really speaks to the liquidity picture that you are seeing in the markets right now. Traditionally, remember the Santa rally is supposed to be the last 5 trading days of the year, so it's supposed to be post Christmas, but traditionally, seasonally, December has actually been a positive month. So you even going into that Santa rally, you do tend to see a lot more positive reaction. This time is a little bit different because of this Fed hangover, if you will, and kind of still the lack of clarity on what February is actually going to look like. So there's almost this complacency in this market, almost this desire to just hop out, close out positions early, which will be interesting to see if the Santa rally does actually come into this year.
So what's going on with the VIX? It's at 23, which is not that elevated, really. I mean, if you look over the course of the year, it's one of the lower points.
It is one of the lower points. Remember, we got very close to 20 earlier in the week, and we were looking for that 20 gauge as kind of the post-COVID norm for volatility, and we still haven't quite hit that, especially since the start of the war in Ukraine. But a lot of people are going to say the VIX is a broken gauge right now, and instead you should be looking at bond volatility, which is still rising quite a bit. And I would argue that the stock market and the bond market are kind of more in sync at the moment because of these massive moves. So if you look at the MOVE index relative to the VIX, that's the one that is actually showing, look, things aren't normal underneath the hood, whereas the VIX would almost suggest on the surface that things are as they should be.
Well, that's bond volatility. What about bonds overall? Because we've spent some time saying we don't want bonds at all. Now a lot of investors are saying we do want bonds because those rates have come back up.
Right. And, you know, Ira Jersey over at Bloomberg Intelligence made a really, really smart point at a Bloomberg Intelligence panel yesterday, actually. And he said, look, there is almost a ceiling that those 2-year yields are hitting because the market, not just the equity market, but the bond market is pricing in cuts in the back half of 2023. If you weren't pricing in those cuts, that 2-year yield would be much, much higher right now. Look out farther onto the curve. The 10-year yield, we're looking at 3.47. That should be higher too if we're looking at a terminal rate of 5.1% in March, which is what the Federal Reserve had indicated on Wednesday. So once again, there is some disconnects in the bond market between what the Federal Reserve is saying and what the market is believing. And they're still saying, look, those cuts, they're going to happen because that recession is going to happen.
Yeah, one of my favorite stories of the day is the extent to which the market's pricing that cuts and the Fed saying absolutely not. Followed up with petroleum, with oil, because we now have a report that the administration is going to start buying for the Strategic Petroleum Reserve once again.
They are. And remember, they had said this, I want to say a couple months ago as well. They were looking for the prices, I believe, to drop somewhere in the 60s level, definitely below the 70 level. They were also waiting to make that announcement post the price cap imposed on Russia. So I believe it's $62 for the price cap on Russian oil right now. But remember, that is still higher when you look at what Russian crude is trading at relative to the international benchmark, which of course is Brent crude. But right now, some headlines coming out earlier in the hour, the U.S. is soliciting bids for a purchase of about 3 million barrels of oil in February. So it looks like that did create a little bit of a bump in the equity market, in the commodity market, but NYMEX crude is still lower on the day.
But it mainly tells you something about the price of gas at the pump, because they wouldn't do that if they didn't think they could afford to, because the price has come down so much.
Right.
Thank you so much to Kriti Gupta. You can watch Kriti again as she anchors at 1 p.m. Eastern Time a.m. on Bloomberg Markets. Check out the Balance of Power newsletter on the terminal and online. Coming up on Balance of Power, we're going to continue on Bloomberg Radio. In our second hour, we'll talk to the man who ran the digital campaign for Mitt Romney. And this is Bloomberg.